Welcome, everybody, to today's SQM podcast with Louis Christopher. Um, we thought we'd do something a little bit more topical today, Louis, that's been on everybody's minds. And this is the expanded 5% deposit scheme that the government's put in place. And obviously the fact that they've brought the rollout forward to October 2025 when it was set to be January next year. Firstly, from your perspective, what are your thoughts around this?
I think the scheme and the announcement, it's not just bringing it forward, it's also the announcement of the elimination of income caps on it. So basically, any first home buyer can apply for it. The fact that they've lifted housing price cap, they've ensured that it's now applied to existing and new properties. All this is going to see a surge in first home buyer activity. There's no doubt about it. So this is really big news.
So, Louis, how much could this potentially save buyers, first home buyers? And other than obviously the first home buyers, who really benefits from this scheme?
So in terms of the saving, the savings predominantly going to be on the mortgage insurance. And assuming a $1.5 million dwelling, which first home buyers now can qualify for up to $1.5 million in terms of price in New South Wales, that saving on LMI insurance would be $60,000 for the first year. Plus, think about the interest expense you're saving on that 60 grand, because that's normally added to the cost of the loan. So this is a substantial saving combined with the existing first home buyer stamp duty grants that you see in various states and territories now. You combine that and you're talking about potentially saving up to $100,000 or more for a first home buyer, depending on which state you are in. So this is, Sam, this is a huge saving and essentially equates to the first home owners boost scheme that we had in 2009 following the GFC. And that was a saving a potential of about $14,000 to $15,000. In that year, we saw a doubling of first home buyers enter into the marketplace, and housing prices rose in 2009 by about 18%. Now, that was a combination of this first home owners boost that was introduced at the time, plus interest rate cuts. But we've already been getting interest rate cuts. So going to your next question, who else does it benefit? Sellers. Prices will be going up as a result of this. I've no doubt about it.
And look, that is obviously fantastic for the health of the market in general. But what are the risks that you foresee with an incentive like this?
Well, it will boost the market, but in terms of the health of affordability over the medium to long term, it's going to be bad news, right? So first home buyers who get in early, they'll likely do okay because they won't see large housing price rises initially. But if you jump in later, like say 12 months from now, it's very likely the market's going to be up. And so those savings are going to be negated by price rises. And overall, these type of schemes, which basically bring demand forward, don't really address the root problem of our housing affordability. So I would argue that yes, you'll see a boost for the housing market, which is great for sellers, great for agents. There'll be an increase in turnover. But for those people who arrive later into the market, it's not going to be so good.
And what, if anything, is the government doing to kind of combat these problems? Because obviously they're probably foreseen that this is going to be an issue. What are the things that they're doing to kind of combat these potential issues?
Well, I'm not so sure they have foreseen it because Treasury has put a forecast out that they are expecting housing prices to rise only by about 0.5% as a result of this initiative. I strongly disagree with it. It's going to go up by a lot more than that.
What's your prediction on that, Louis, just to give the viewers?
Okay, so the precedent is what was said in 2009, where we had a combination of interest rate cuts plus a first home owners boost. In that year, housing prices rose within 12 months of the initiative back then by 18% nationwide. 18%. Right.
That's
So
enormous.
I don't know if we're going to go up that amount this time, but I think most of us should be penciling in, combined with these interest rate cuts we're already having, that housing prices will rise by at least 10% over the next 12 months. So that's one we can almost lock in now, given this announcement.
And that sort of leads me on to a bit of another question about, and maybe a bit of a concerning one about kind of doubling this up with the interest rate cuts from the RBA,
Yeah,
which has been very clear that they're going to continue to do these interest rate
yeah.
cuts. Will this potentially forestall further cuts?
Oh, that's a good question. Look, if the housing market really ramps up, that will put pressure on the RBA to be more cautious at the minimum. Even though they've always stated, "Oh, look, we don't set policy, interest rate policy on what housing prices do." I think they kind of do just quietly. They definitely consider it in the background.
Well, they'd have to, right? Because it's one of the main driving forces of the Australian financial market.
Well, it can have secondary pressures on the economy. No question about that. It can affect productivity. It can. It definitely has a wealth boost effect where you see an increase in demand, aggregate demand
Mhm.
in the economy. But the combination of perhaps affecting productivity and that aggregate demand into more speculative things can create a bit of an economic bubble, and that's what they'll be watchful of for sure.
So, thinking about that, obviously with the RBA, how does this how does this particular agenda fit into the government's broader housing affordability agenda? Because obviously they've got the target of building
1.2 million dwellings, right?
exactly.
And they've been copying criticism in the media because they're well and truly behind the run rate required each year now. I think what they're hoping out of this is an increase in housing activity will mean an increase in supply. So a lot of first-home buyers may go and buy a new home, keeping in mind this scheme is for existing properties as well. But there will be an increase for new homes, no question about that. And so that may help increase building activity as what happens with every increase in aggregate demand for housing, you see eventually a response from the supply side of the marketplace. Now, I think what they're hoping out of this is that the supply side will respond in time over the next 2 years back towards the required run rate that they need of about 240,000 dwellings being built each year to meet 1.2 million dwellings by mid 2029.
But as we've discussed on a previous podcast, that still doesn't fix the issue in the construction space that we've spoken about around lenders lending money to for further construction, because that seems to me to be one of the biggest bottlenecks around new development is lenders actually lending money to builders
Developers,
and
yeah.
developers outside just your lend leases and your really large organizations.
Yeah, it's definitely been a constraint in the market. And what many property developers have been doing is they've been accessing the private credit markets within the funds management space, which we know a lot about as well. So we're seeing a lot of activity on that front, but it's often done at a higher lending rate compared to what the banks can actually do. And so therefore, that once again increases the costs and the risks of a development. Over and above that, I think um, the quality of developments over the past 10 years has been seriously questioned
Mhm.
in a number of states. There's been a number of failed developments which have occurred, which have meant that investors and first home buyers have bought into these developments have lost considerable money. And so there's been a bit of a smell around new developments, particularly high density developments over that time. And I think many home buyers have been holding back on buying off the plan as a result. So I think there needs to be confidence returning to the development market, either through enforcement of existing regulation or new regulation to protect consumers in that space. I think the combination of the restrictions in credit, plus the lack of confidence and equality, plus other factors out there such as taxes on new properties, which are still very, very high, up to 40% of the cost of a new home, um, all have impacted the supply side in the housing market.
And to that rate, whilst this initiative on paper seems like a good initiative and great for sort of, as we discussed in our previous podcast, our Gen Zers and our millennials moving into the market, if the supply doesn't increase and if the ability for construction of new homes and new developments doesn't increase, we probably will see a bottleneck in those situations.
Oh, yeah,
Correct?
yeah, we'll see, and that will push up prices. So I think that we'll see a response from the supply side, and the government is trying other initiatives as well, as, for example, a build to rent scheme to try and increase a little bit more on the social housing side. There will be a response. It's just a matter of whether that response is going to meet the surge in demand that we're very likely to see over the next 12 months.
Is there a potential for rort in this system? To give you an example, let's say you've got a married couple.
Yeah.
One party has their name on one property that they've purchased, but the other partner is not named on that property. Is there a potential for the second party to put first home buy in their own name as well?
Well, I wouldn't rule it out, Sam. I mean, we saw rorting with those COVID grants, if you recall, by many businesses because the rules around it weren't tight enough. There wasn't enough rules, and I haven't seen a lot of ruling around this scheme. And so potentially, yeah, you're going to see some people maybe rorting the system, especially given the fact now we've got a situation where there's no income threshold at all. Now that's going to be very interesting. I suspect we're going to see a lot of very young people who are going to be financed by their parents because you qualify so long as you're 18 or over.
Oh, wow.
So think about those parents who will look at this and say, great, here's a time to buy the kid's property, and they put down a deposit, they guaranteed a loan with the bank. Kids may be just coming out of uni or still in uni, but it's all covered by the parents, but the property's still in the child's name. I think a lot of that's going to go on.
And that's a real concern. I sort of remember from those COVID grants, particularly the small business grants, there were a lot of big businesses that sort of abused those grants, and then the clawbacks, because they couldn't get it back from the bigger businesses, were vicious on the smaller businesses.
Yeah, that's right. Yeah, look, I don't know, we'll see clawbacks, but I'm just concerned that there's not enough rules around who qualifies as a first home buyer, and particularly, in fact, there's now no income caps whatsoever.
And what should we be looking for over the coming months?
I think we'll see in the coming weeks. So watch our auction clearance rate series that we issue each Tuesday afternoon. We've already been recording a rising trend in auction clearance rates for Sydney and Melbourne. But I think after this announcement, over the next couple of months going into the spring and early summer, we're going to see an increase in volume, which is good, as you traditionally see over the summertime period. But auction clearance rates are actually going to hold ground or even indeed rise. If we see a rise in clearance rates together with a rise in scheduled auctions, that signals a booming market, that's for sure.
And that also leads me to say to our viewers, guys, keep a real eye on our distressed property listings as well. That's a great opportunity for you to get into the market as well, particularly if you're a first home buyer.
Yeah, I think we're likely to see a fall in distressed selling activity with the combination of the cuts in interest rates, more people entering into the market. So it is likely we'll see less bargains out there, less potential bargains over the next 12 months, in my view. But we'll wait and see.
Absolutely. Well, guys, that's all we have time for today. We'd also like to know your thoughts as well. So please come in with any thoughts that you have around this new government initiative, any experiences you have. If you're looking to buy a new property at the moment, we'd love to hear from you. And please visit us at sqmresearch.com.au, particularly for updates, as Louis mentioned, on our auction clearance rates. Thank you so much, Louis, for your time.
Thanks again, Sam. And for first home buyers out there, look, I can't say this enough. If you've got your savings there, you're looking to take advantage of these schemes, I would recommend moving sooner rather than later.